Hello, my name is Brooklyn and I will demonstrate the calculation for question 1. First, let's read the question. Okay, technology Berhad, evaluating new system. And the first system refers system A, initial cost 400,000 and have annual maintenance cost 20,000 pre-tax. System A entirely will be replaced entirely after 4 years, while system B has higher initial cost 600,000 purchase and installation. The annual operating cost is lower at 10,000 pre-tax. Both systems will be depreciated using straight line method until the value reaches 0. Tax rate is 30% and discount rate is 16%. And we need to develop cash flow stream for both systems and determine the equivalent annual cost ESC for each, and which systems will be selected and why. Alright, as I mentioned earlier, there are two systems, system A, system B. IO 400,000, IO 600,000 for system B. The EBIT is earning before interest tax 20,000, and this is to 10,000. And ECS, which is system A 4 and system B 6. Depreciation 100,000 and 100,000. How to find depreciation? IO divided by N. The tax rate is, as I mentioned earlier, 30% or 0.3. First, system A, we need to find the OCF. Formula for OCF is EBIT bracket 1 minus tax rate plus depreciation bracket tax rate. The OCF for system A is 16,000 and system B 23,000. Step 2, we need to find the NPV. The formula will be OCF bracket PVIFA percentage N minus IO. So system A, put down all the numbers into the formula and the answer will be negative 355,228.8. System B, take in all the number into the formula and then the answer will be negative 515,251.9. Step 3, we need to find the NPV. Alright, system A, the formula will be total NPV divided by PVIFA percentage N. Therefore, put all the numbers and the answer will be negative 126,999.04. And system B, total NPV divided by PVIFA percentage N. Therefore, the answer will be negative 139,835.51. So, system A should be selected because it has lower equivalent annual cost. Next, we will move on to the question B, Roman 1. Alright. Question B. This is the question. First, we need to find the operating cash flow, OCF, with the upon expect to sell 10,000 units, and required rate of return is 10% and tax rate is 35%. Therefore, take out all the information. Price 30 ringgit and is 5, fixed cost 200,000, variable cost 10 ringgit. The IO will be 900,000. Quantity, which is expect to sell 10,000 unit. The ROR, rate of return, will be 10% or 0.10. The tax rate will be 35% or 0.35. The formula for CF will be bracket P minus variable cost, Q minus fixed cost, and 1 minus tax rate plus depreciation tax rate. Put all the numbers into the formula and then the answer will be 63,000. Next, question B, Roman 2. Should the firm proceed with the project? This is the information. Investment in net working capital 30,000. Salvage value at the end of 5 years 150,000. Number of units 12,000 units. So the calculation will be, we need to take out all the information. Survey value at the end of 5 years 150,000. Number of units sold 2,000 units. We need to use the OCF formula. Put all the numbers into the formula and then The answer will be 89,000. Like I said, we need to find the salvage value, after tax salvage value. So the formula will be salvage value bracket 1 minus tax rate. So the answer will be 97,500 ringgit. Next, we will continue to create a table projected cash flow, and these are the information that we need to put in the table: OCF, initial net working capital, changes in net working capital, NWC recovery, initial outlay, after tax salvage value ATSV, and total projected cash flow. And then we need to find the NPV. So the formula will be CF bracket PVIFA percentage N plus CF PVIF percentage N minus IO plus NWC. Put all the numbers into the formula. You can find the numbers here, and then we will get the answer for the NPV, negative 513,454.05. Therefore, the firm should reject the project. This is because the NPV is negative.
Hello, my name is Muhammad Hanif, and I'll be explaining question number 2. Question number 2. Zahora Berhad, a fabric manufacturer, is currently an unlevered firm with an weighted average cost of capital WACC of 12%. The firm anticipates maintaining its earning before interest and taxes EBIT at 1.5 million ringgit per year. They are considering investing in a project that costs RM2 million and is expected to generate an annual after-tax cash flow of RM750,000 in perpetuity. Consequently, the firm plans to change its capital structure to include 40% of the debt which they can obtain from a bank at the rate of 10%. The firm's current tax rate is 30%. Question A. Calculate the cost of equity before restructuring. Justify your answer. B. Calculate the cost of equity after restructuring. C. Calculate the WACC after restructuring. D. Calculate the NPV of the proposed project. C. Determine the firm value without debt. First of all, answer for question A. A. The cost of equity before restructuring. The cost of equity before restructuring is 12%. Why? Before restructuring, Zahora Berhad is an unlevered firm, which means it has no debt. Thus, the cost of equity is equivalent to the value of the weighted average cost of capital WACC. Without debt, a firm's capital structure consists purely of equity. Therefore, we'll proceed to B. B. Cost of equity after restructuring. Using Multidani-Miller 2 proposition with tax formula, we can deduct RE equivalent to RU plus RU minus RD in bracket times D over E times 1 minus T. What is RE? RE refers to the cost of equity before restructuring. RU refers to the cost of equity after restructuring. RD refers to the cost of debt. D refers to the cost of debt. E refers to equity, and T refers to the tax rate. So we deduct that the debt from the question itself, the debt is 40%. Therefore, we need to find the equity. So to find the equity, we conclude that the firm value is 100%. Therefore, 100% minus 40%, we can find out the equity is 60%. So plug into our formula. Formula is RE equivalent to RU plus in bracket RU minus RD times D over E times 1 minus T. Plug all in the value. 0.12 is our cost of equity before plus 0.12 minus 0.10 times 0.4 divided by 0.6 times 1 minus 0.3. We can get that the cost of equity after restructuring is 0.1293 or 12.93%.
3.
Following on to question C, the WACC after restructuring. The formula of WACC is in bracket E divided by V times RE plus in bracket D divided by V times RD times 1 minus T. We concluded the firm value that we assume is 100%. So 0.6 divided by 1 times 0.1293 refers to the cost of equity after restructuring plus 0.4 divided by 1 times 0.10 times 1 minus 0.3. We get 0.07758 plus 0.028. So the WACC after restructuring we will get 0.10558 or 10.558%. Following on to question number D. NPV of the proposed project. From the question, we get to know that the after-tax cash flow perpetuity is RM750,000. The initial investment is RM2 million, and the WACC that we get just now is 10.558% or 0.10558%. Following on to the formula of NPV, net present value perpetuity, is C divided by R minus I. C is the 750,000 cash flow. R refers to the WACC that we just obtained, and I refers to the 2 million initial capital. So plug in the value 750,000 divided by 10.558% minus 2 million. Okay, we can get 710,361.8.11 minus 2 million. Then we can get the total answer of the NPV of the proposed project is 510,3618.11. Following on to question E and the last one, the firm value without debt. So we use the formula of the value of unlevered firm with tax, which is VU equivalent to EBIT minus 1 minus T divided by RU. Plug in the values. VU equivalent to 1,500,000 minus 1 minus 0.3 divided by 0.12. We can get the answer for the firm value without debt is 8750,000.00. That is all from me for question 2. Thank you.
Assalamualaikum and good morning everyone. Today I'm going to talk about the question 3. Question 3A. If the target capital structure of Nuha Berhad is 1.5, weighted average cost of capital is 10% and the tax rate is 30%. Determine question 1. Cost of equity capital if the after tax cost of debt is 7%. Question 2. Before tax cost of debt capital if the cost of equity is 20%. And lastly, given the WACC of Nuha Berhad is 9.96%, the cost of equity and before tax cost of debt are 18 and 9 respectively. Determine the target debt to equity ratio assuming the tax rate is 34%. First question, cost of equity capital if the after tax cost of debt 7%. Firstly, WACC bracket E plus V plus cost of equity bracket plus bracket D divide V plus cost of debt. Target capital 1.5, WACC 10%, tax rate 30%, after tax cost of debt 7%. D divide E 1.5, V equal E plus D equal 1 plus 1.5 equal 2.5. E divide V 1 divide 2.5 equal 0.4. D divide V 1.5 divide 2.5 0.6. After that 0.10 equal 0.4 plus cost of equity plus 0.6 plus 0.07. After that 0.10 bracket 0.5 plus cost of equity plus 0.042. After that 0.10 minus 0.042 equals 0.4 plus cost of equity. 0.05a equal 0.4 plus cost of equity. Cost of equity equal 0.058 divide 0.4 equal 0.145, 14.5%. The answer is 14.5%. And the second question is 0.10 equal 0.4 plus 0.2 plus 0.6 plus cost of debt plus 1 minus 0.3. After that 0.10 equal 0.4 plus 0.2 plus 0.6 plus cost of debt plus 0.7. 0.10 equal 0.08 plus bracket 0.6 plus cost of debt plus 0.7. 0.10 minus 0.08 equal 0.6 plus cost of debt plus 0.7. 0.02 equal 0.6 plus cost of debt plus 0.7. Cost of debt 0.02 divide 0.42 equal 0.0476. The answer is 4.76% for question 2. The question 3 is E divide V equal 1 divide 1 plus D divide E. Firstly, 0.0996 equal bracket 1 divide 1 plus D divide E plus 0.18 plus bracket D divide E divide 1 plus divide D divide E plus 0.09 plus bracket 1 minus 0.34. 0.0996 equal bracket 0.18 divide 1 plus D divide E plus bracket 0.09 plus 0.06 plus D divide E. Divide 1 plus D divide E. 0.0669 equal bracket 0.18 divide 1 plus D divide E plus bracket 0.09594 plus D plus E divide 1 plus D divide E 0.0996 equal 0.18 plus 0.09594 plus D divide E divide 1 plus D divide E 0.0996 plus bracket 1 plus D divide E equal 0.18 plus 0.09594 plus D plus E 0.0996 plus 0.096 plus D divide E equal 0.18 plus 0.0594 plus D divide E 0.06996 plus 0.0402 plus D divides E equal 0.18 0.0402 plus D divide E equal 0.0804 D divide E equal 0.0804 divide 0.0402. The answer is 2. The question B, Amani Foundation is looking for fund of 8 million ringgit Malaysia through issuance of bonds, preference stock and common stock. The mixture of the capital is 2 million ringgit bonds, 2.5 million ringgit preferred stock and 3.5 ringgit million common stock. The information of each fund is as follows. The bond have a coupon rate of 9% and maturity life of 10 years. The fluctuation cost of the bond is 7% and the market price is 1,200 ringgit Malaysia. The preferred stock have a market price of 100 ringgit and pay a dividend of 8 ringgit 50 cent and fluctuation cost of 3%. The dividend on a common stock to be paid by the company is 3 ringgit and the fluctuation cost is 4%. The dividend growth in 5% constant and the market price of the stock is 16%. If the company pays corporate tax rate of 30%, calculate question 1 weighted average cost of capital. Question 2 the weighted average fluctuation cost. And lastly the true cost of the fund needed. So first question 4B, weighted average cost of capital. The formula is cost of debt equal coupon payment divide market price plus bracket 1 minus fluctuation cost. Coupon rate 9%, market price 1,200 ringgit, fluctuation cost 7%. So cost of debt 0.09 plus 1,000 divide 1,200 plus bracket 1 minus 0.07 0.075 plus 0.93 equal 0.06975. The answer is 6.975%. After tax cost of debt. After tax cost of debt equal cost of debt plus bracket 1 plus 1 minus tax rates 0.06975 plus bracket 1 minus 0.30 0.048825. The answer after tax cost of debt 4.8825%. Cost of preferred stock dividend RM8.50. Market price 100. Flotation cost 3%. Cost of preferred stock RM8.5 divide 100 plus bracket 1 minus 0.03 0.085 plus 0.97 0.08245. The answer is 8.245% for cost of preferred stock. Cost of common stock dividend RM3, market price RM16, growth rate 5%, flotation cost 4%. Cost of common stock equal bracket 3.00 divide 16 plus bracket 1 minus 0.04 plus 0.05 0.1875 plus 0.69 plus 0.05 0.18 plus 0.05. The answer is 0.23 or 23%. Proportion of each component. Total capital 8 million, bond 2 million, preferred stock 2.5 million, common stock 3.5 million. Proportion of debt 2 divide 8 0.25. Proportion of preferred stock 2.5 divide 8 0.3125. Proportion of common stock 3.5 divide 8 0.4375. WACC equal 0.25 plus 0.048825 plus bracket 0.3125 plus 0.08245 plus bracket 0.4375 plus 0.2 0.01220625 plus 0.02575625 plus 0.100625. The answer is 0.138596875 or 13.86%. The question 2, the weighted average flotation cost WAFC bracket 0.25 plus 0.07 plus bracket 0.3125 plus 0.03 plus bracket 0.4375 plus 0.04. WAFC 0.0175 plus 0.009375 plus 0.0175 0.044375 or 4.44%. The answer for WAFC. The question 3, the true cost of the fund needed WACC bracket 0.25 plus 0.048825 plus bracket 0.3125 plus 0.08255 plus bracket 0.4375 plus 0.23 0.01220625 plus 0.02575625 plus 0.02 100,625. The answer is 13.86%.
Hello, my name is Brooklyn and I will demonstrate the calculation for question 4. Alright. As you can see, question 4 have A and B. In A, there are 1 Roman, 2 Roman, 3 Roman, and 4 Roman. We'll start with this first. Alright. Question 4, A1. So, check out all the information. The IO will be 400,000. N is years, 8 years. Q quantity 1 to 5 unit. Price 10,000. Variable cost 8,000. Fixed cost 65,000. Rate of return 12% or 0.12. The tax rate 28, 0.28. And depreciation, how to get the depreciation? IO divided by N. IO divided by N. 400,000 divided by 8, therefore 50,000. And then we need to create these 3 tables: lower bound, base case for upper bound. Alright, where do we get these numbers? We get from Q quantity, P price, variable cost, and fixed cost. Alright, we will start with step 1 for base case. For base case, we need to calculate the OCF first. OCF, the formula will be P minus variable cost, Q minus fixed cost, and 1 minus tax rate plus depreciation tax rate. Put all the numbers into the formula, and then the answer will be 147,200 ringgit Malaysia. This is for base case. And then after settle OCF, go to NPV. The formula for NPV, OCF bracket PBIFA percentage table. PBIFA this we need to get from the table. Okay, and then put all the numbers into the formula. The answer will be 331,230.72. This is step 1. And then we move into the worst case. Alright, as usual, calculate the OCF first, the formula, and then put all the numbers into the formula, and the answer will be negative 21,280,000. And then after settle down the OCF, we move into the NPV. Yes, the step will be like this: OCF first and then NPV. The NPV, the formula will be OCF bracket PBIFA percentage N minus IO. Therefore, the answer will be negative 505,710.53. That's for worst case. Alright, after that, we move into the A2. What is the sensitivity of the base NPV to changes in unit price? Base NPV to changes in unit price. Alright, this is the calculation. First, we need to calculate the OCF. The formula of OCF will be P minus variable cost, Q minus fixed cost, 1 minus tax rate plus depreciation tax rate. And then after all the numbers have been given, and then calculate and get the answer. The answer will be 57,200 ringgit Malaysia. Alright, the NPV, the formula will be OCF bracket PBIFA percentage N minus IO. Alright, the answer will be negative 115,853.28. And then as the question want the sensitivity, we need also to calculate the sensitivity. This is the calculation for sensitivity. And then the NPV will be used negative 115,853.28 minus 331,230.72. Where do I get this? Get from the base case NPV. Alright. And then divide and then this below need to minus. The answer will be 447.08. Alright, we move into the next step. The OCF, yes. The formula for OCF will be P minus variable cost, Q minus fixed cost, 1 minus tax rate plus depreciation tax rate. Alright, P minus 8,000. Alright, we go into the table first. P will be from upper bound and 8,000. Variable cost, this. Yeah, we take from the best case. Therefore, the formula, put all the numbers into the formula, and then the answer will be 237,200. After done with OCF, we go to NPV. Formula for NPV as usual, and then after that we get the answer 778,314.72. After finish the OCF and NPV, we need to calculate the sensitivity. This is the sensitivity calculation. The numbers, where do we get this? Right here. This we will get from best case NPV. Why? Because the equation 1 best NPV, and then we will get the answer 447.08 or 447.10. Next, we go to question A3. What is the accounting break-even level output for this project? The keyword accounting break-even level output. Accounting break-even level output. Therefore, this will be the formula. Alright. Accounting break-even, the formula will be fixed cost plus depreciation divided by price minus variable cost. So the fixed cost will be here 65,000, and then the depreciation will be 50,000, and then the price 10,000, variable cost will be 8,000. Therefore, plus, divide and minus, the answer will be 57.5 or 58 units. Alright, we move into the question 4A. 4. What is the degree of leverage at the accounting break-even level? The keyword will be degree of leverage, accounting break-even level. Alright, so here's the formula. Degree of leverage, 1 plus fixed cost divided by depreciation. 1 plus fixed cost divided by depreciation. So 1 plus fixed cost 65,000 divided by depreciation. Depreciation will be 50,000. So the answer will be 2.3. Alright, we move into the last question of question 4. Question 4B. What is the discuss the standalone principle in project evaluation? The keyword will be standalone principle. Alright, this is the answer. I will explain. In project evaluation, the standalone principle is the idea. Alright, the idea of analyzing a project as though it were a different entity with own income, cost, and investment requirement. This implies that in assessing a project, only the incremental cash flow directly related to the project are taken into account. Thus, the complete financial performance of the organization is neglected. This method emphasizes the particular financial consequences of the project itself, therefore streamlining the review process. That's all for question 4. Thank you.
Assalamualaikum and hi. My name is Rizwan bin Hamdan, BG22160485. So basically I'm going to explain on how to answer this question 5 of this assignment 2 corporate finance. So let's get through the question.
I'm going to show the question here. So the question 5, there are a few questions that we need to answer. So the first one, I go through the first one, which is the define synergy. What is the meaning of synergy? This is what I observe and I understand about synergy. The idea of synergy states that two business combined performance and value will be higher than the sum of their individual components, because it happens when companies combine or work together to produce efficiencies, lower costs, or higher profits that would not be achievable on their own. So basically, if they are put together their teamwork, it's going to be giving a better result. Now we go through to the next question for question 5, which is B. Explain the following defensive tactics. So there are 3 tactics that I need to explain. So I go through the first one, which is the corporate charter. The meaning of the corporate charter is that the fundamental document that creates a business and describes its laws and structure is called a corporate charter. A supermajority vote for mergers or restriction on shareholder ability to call for special meetings are 2 examples of measures that can be included to prevent hostile takeover. So that's what's the function of the corporate charter. Now to the next one, golden parachute. So it's an interesting part, which is if an executive gets fired because of takeover, a golden parachute is a contract that offers them substantial financial perks, including stock option or cash incentive. This strategy makes hostile takeover more costly for the acquiring business, which deters them. Yeah, that's what interesting about it. And now the last part is white knight. White knight. In order to protect a target company from an attempt to take over by a less acceptable bidder, a more favorable corporation known as white knight will purchase the target company by preserving the interests of the target firm and providing better terms. The white knight is viewed as a lifesaver. So basically, white knight is one of the useful stuff to use to defend whenever something happen lah. Okay, enough of the theory part. Now I answer the calculation part, which is this one. I will explain first the situation over here. Sarah Corporation is bidding to take over Belaisa Berhad. Sarai has 30,000 share outstanding, and they are selling at 50 ringgit per share, whereas Belaisa has 20,000 share outstanding, selling at 17 ringgit 50 cent per share. Sarai estimates the economist gain from the merger to be 100,000 ringgit. So the first question about the situation is that I need to compute the value of Belaisa to Sarai. So here are the details. We need to outline the details first, so it's easier for me to do calculation. So the first one is outstanding share of Belaisa, which is 2,000 shares from the information. Price per share of Belaisa, 17 ringgit 50 cent. And the economic gain from merger is 100 ringgit. 100,000 ringgit. So this is the step 1. Calculate market value for Belaisa. So these are the formula. Value for Belaisa, outstanding share, which is 20,000 times price per share, RM 17 ringgit 50 cent. So it's equal to RM 350,000 ringgit. Okay, so the next step, we need to calculate total value of Belaisa to Sarai. So the formula is value of Belaisa, which is this one, gonna be plus with economic gain, 350,000 ringgit plus with 100,000 ringgit equals to 450,000 ringgit. So these are the answer for question 1, value of Belaisa to Sarai. Now we move on into the next question, the next calculation part, which is, the question sounds like this. If Belaisa can be acquired for RM 20 ringgit a share, what is the NPV of the merger to Sarai? So as like basic things, we need to outline the details first, so it's easier for us to calculate. So these are the details: 20,000 per share, acquisition price RM 20 ringgit, economic gain RM 100,000 ringgit. So basically these details is important to outline so that we easy to write on the calculation, so there are no mistake. So this is the important, even though it's a basic and it's simple thing, but we need to do this, the details. We need to outline the details. So I proceed to the next one, which is the step 1. Calculate total cost of acquiring Belisa. Outstanding share times price per share. This is the formula. So means that 20,000 per share times RM 20 ringgit. So that it equals to RM 400,000 ringgit. And that's not finished yet. So there are step 2. Calculate value of Belisa to Sarai. So we already calculate this, which is this at the top, the first one, which is RM ringgit Malaysia 450,000 ringgit. So we already have that from the first question. Okay, now we go to the still at the same question, but at the step 3, calculate NPV of merger. So the formula will be NPV, which is equal to value of Belisa to Sarai minus cost acquisition. So which means 450,000 ringgit minus the 400,000 that we get from the step 1. So it equals to RM 50,000 ringgit. So that's the final answer for this question 2. Which is, if Belisa can be acquired for 20 ringgit a share, what is the NPV of the merger to Sarai? So, okay. Now, we move on to the next question. How much will be the price of Sarai per share in the market after the acquisition? So, meaning to say, how much exactly Sarai per share in the market whenever they do the acquisition. So similar to other question, we need to outline the details. Here are the details. Sarai's 30,000 share are 50 ringgit per share. Belisa 20,000 per share, and also Belisa price per share is 17 ringgit 50 cent. So now we move on to the step 1. Calculate value of Sarai before acquisition. These are the important part. 30,000 times 50 ringgit equals to 1,500,000. So that's the value of Sarai before acquisition. Now we need to calculate value after acquisition. So how we get that number is that these are the formula. We need to add value of Sarai plus value of Belisa to Sarai. So which means this 1,500,000 plus the 450,000 previously we calculated. So 450,000 then equals to 1,950,000. So that's the total of value after acquisition, but it's not finished yet. So we need to calculate. The next step is we need to calculate the total share after acquisition. So these are the formula. 30,000 share plus 20,000 share equals to 50,000 share. Because why we need to add both share is because they are do acquisition, which is they combine together, merge together. So that's why we need to add this 30,000 and 20,000 share. So it equals to 50,000 share. Now we go to the last step, which is calculate price per share after acquisition. So now the total combined value that we calculate previously, which is on step 2, 1,950,000, we divided it by the how many totals share after acquisition, which is 50,000 share that we already calculate on step 3. So now we divide 1,950,000 with the 50,000 share, and it's equal to 39 ringgit per share. So that's what the answer for this question. How much will be the price of Sarai per share? So these are the answer. RM 39 ringgit per share. So we move on to the last question for this question 5. Last part of this question 5 is, which is, what is the NPV of the merger to Sarai when it uses an exchange of stock? I repeat, what is the NPV of the merger to Sarai when it uses an exchange of stock? So Sarai details as basic things. We need to outline the details here. That's important stuff, even though it's simple, but it must need to be outlined so we have no mistake. So this one, 30,000 share, 50 ringgit per share for Sarai details. These are the Belaisa details, 20,000 share, 17 ringgit 50 cent per share. And now economic gain from merger is, which is they combine together, which is 100,000 ringgit. So next part, we need to calculate the total value of Sarai. So total value Sarai, how we get it is by 30,000 share times 50 ringgit equals to 1,500,000. So now step 2, calculate market value of Belaisa. So these are the details. 20,000 share times 17 ringgit 50 cents equals to 350,000 ringgit. Now we move on to the step 3, calculate cost of acquisition using stock. Okay, so total acquisition cost 20,000 times 20 ringgit equals to 400,000 ringgit. So this 400,000 ringgit will be divided into the 15 ringgit per share equals to 8,000 per share. Yeah, so these are the new price per share lah. So 8,000 share. Now we move on to the step 4, calculate total value after merger, after they combine together. So we need to add all of the amount, 1,500,000 plus the 350,000 plus the 100,000 from the economic gain, and equals to 1,950,000. So now step 5 is that we need to calculate total share and price per share after merger. So these are the calculation. 30,000 plus 8,000 equals to 38,000 share. So this share will be divided using here this calculation, which is 1,950,000 divided by 38,000 per share. So equals to 51 ringgit 32 cents, and that's what the total price per share lah. And now we move on to the last part, which is we need to calculate NPV, new share value, 8,000, like we already calculated, 8,000 times 50 ringgit equals to 400,000. Now to find the NPV, 100,000 plus 350,000 ringgit, so equals to 450,000, and that's how we get to the NPV, because it's 7 mark. So that's why there are a few of calculation we need to put out here so that we get the mark 7 mark. And these are the complete calculation for this question number Roman number 4. What is the NPV of the merger to Sarai when it uses an exchange of stock? So these are the last question, and yeah, that's it.
That's basically my understanding and how I do the calculation for this question 5. And this question 5, what I learned is that it's basically using the chapter merger and acquisition. So I think that's it for me. Thank you. That's basically my...
Hello again, my name is Muhammad Hanif and I will be explaining question number 6A. Question 6A. Halton Group is considering one of the two mutually exclusive projects, Vogue and Famous. The after-tax cash flow for the projects are as follows. For year 0 until 6, Vogue starting with negative 160,000. From year 1 until 5 is perpetuity of 50,000. For Famous, it started with negative 220,000 at year 0. For year 1, 25,000, year 2, 35,000, year 3, 60,000, year 4, 54,000, year 5, 38,000, year 6, 30,000. Assuming the cost of capital is 12%, you are required to: number 1, calculate payback period, net present value, profitability index, internal rate of return for both projects. 2, determine the best project that Halted Group should invest. Number 1, A, payback period. Payback period for Vouch is as follows. Year 1, we take negative 1 at 60,000. The cumulative cash flow period it will be 0. Year 1 is negative 1 at 60,000 plus 50,000, it will be negative 1 at 10,000. Year 2, same as year 1, the remainder of 110,000 plus 50,000 will be negative 60,000. Year 3, same as year 1 and year 2, will be negative 60,000 plus 50,000, equivalent to negative 10,000. Year 4, negative 10,000 plus 50,000 will be 40,000 positive. Year 5, 40,000 plus 50,000 will be 90,000. As the years that that needed for the cumulative cash flow will be positive is 3 years, because negative 1 at 10,000 is first year, negative 60,000 is the second year, negative 10,000 is the third year. That will be 3 years first. So to find the remainder for the positive, but we still have the negative 10,000. So Vouch negative 10,000 divided by 50,000 will be 0.2. So the payback period for Vouch is 3 plus 0.2 will be 3.2 years. For Famous, we have 6 years, which is 0, 1, 2, 3, 4, 5, and 6. Year 0 will start with negative 220,000. So year 1 will be negative 220,000 plus 25,000 will be negative 195,000. Year 2, negative 195,000 plus 35,000 will be negative 160,000. Negative 160,000 from year 2 plus 60,000 will be negative 100,000. Negative 100,000 from year 3 brought to year 4 plus 54,000 will be negative 46,000. Negative 46,000 from year 4 brought to year 5 plus 38,000 will be negative 8,000. Negative 8,000 plus 30,000 will be 22,000. The years that it takes to be positive will be 5 years, from year 1 until year 5. But we still have remaining of 8,000 in negative. So we need to calculate the time period to be positive. So Famous, negative 8,000 divided by 30,000 will be 0.67. So the payback period for Vouch is 5 plus 0.267 is 5.267 years. So continuing to question the net present value. The net present value for both companies are as follows. We will be using the formula of NPV equivalent to CF times PVIF, N minus I. So the I for Vouch is 160,000. So here we create a table which consists of year, cash flow, PVIF, and the discounted cash flow. So we have year 1, 2, 3, 4, and 5. The cash flow is perpetuity, so all of it will be 50,000 for the remaining 5 years. PVIF, we will be using the PVIF table. We'll be searching from the PVIF table, year 1, year 2, year 3, year 4, until year 5, using the rate of 0.12 or 12%. So the PVIF that we obtain from the PVIF table is 0.8929 for year 1, year 2, 0.792, 0.7972, year 3 0.7118, year 4 0.6355, year 5 0.5674. So the discounted cash flow for year 1 is 44,645, year 2 39,860, year 3 35,590, year 4 31,775, year 5 28,370. So we sum it all up, we can get 180,240. So for the NPV for Vogue is 180,240 minus 160,000. Well, we get 20,240. For Famous, SIM will be applied, but with an addition of year 6. Yes, but the cash flow for Famous is different. So year 1 is 25,000, year 2 is 35,000, year 3 is 60,000, year 4 is 54,000, year 5 is 38,000, and year 6 is 30,000. The PVIF for year 1 and year 5 is same as both, because the value of will be using the same value of 12%, and the accounting year is 1 until 5, but with an addition of year 6, which is 0.5066. So the discounted cash flow for year 1 is for Famous is 22,322.50, 27,727 for year 2, year 3 27 I'm sorry, 42,708 for year 4, 34,317, year 5, 21561.20, and year 6, 15198. So we sum it all up of the discounted cash flow, we can get 163,833.70. Therefore, the NPV will be 163,833.70 minus 220,000, we can get 56,166.30. Moving on to question C, the profitability index PI. Will we use the formula of future present value divided by the initial investment value? So for Vogue, we take the numbers from the sum of the discounted cash flow. So 180,240 divided by 160,000, we can get the profitability index is 1.1265. For Famous, same also, we get the sum, this value from the sum of the discounted cash flow, which is 163,833.70 divided by 220,000, we can get 0.7446. Moving on to D, internal rate of return. For Vogue, the cash flow is perpetuated, which means the cash flow is constant and the same for the remaining 5 years. Therefore, we'll be using the formula of NPV equivalent to CF times PVIFA, comma N minus I. So 50,000 times PVIFA, comma 5 minus 1 is 60,000. Brought it up, equal, this is the equation, and this is the another equation, balance it all up. So 160,000 here, PVIFA, and 50,000 here. 50,000 brought it up to here, 160,000 minus 50,000, 160,000 divided by 50,000, we can get 3.2. But we don't know the PVIFA value yet. So we assume the PVIFA is between 15% and 20%. Please do refer back to the PVIFA table. So if we refer back to the PVIFA table, in order to find the IIR minus 15% divided by 20% minus 15%. 3.2 minus 3.35522 divided by 2.9906 minus 3.3522. This value is obtained from the PVIFA table. This is the value of PVIFA at 15%, and this is the value of the PVIFA at 20%. IRR, balance it all up. This is the can-doable equation. This is the IRR. IRR minus 50% divided equivalent to negative 0.522 divided by 0.3616. IRR equivalent to 2.105 plus 15%. So we can get the vote IRR is 17.105. Okay, moving on to the famous IRR. So we know that the cash flow is varied, so it's different for every year. So we must find the average cash flow if we want to use the formula of NPV. So the famous average cash flow that we obtain is 40333.33. So plug in the value of NPV equivalent to cash flow times PVIFA, n minus I, same as IRR for both formula. 40,333.33 times PVIFA, 5 minus 220,000. PVIFA, 5 equivalent to 220,000 divided by 40,333.33. We can get we can know that the 5.45 is the assuming range of PVIFA. So look back at the table of PVIFA. We know that therefore the PVIFA is between 2% and 3%. So IRR, to find the IRR minus 2%, 3% minus 2%. 5.45 is the value that we get from here. So 5.45 minus 5.6014 divided by 5.4172 minus 5.6014. This is the value of 2% PVIFA. This is the value of 3% PVIFA. So we get IRR minus 2% equivalent to negative 0.1514 divided by negative 0.1842. We get 0.822. So bring back this positive negative 2% to here, we can get positive 2%. So the IRR for VOOC is 2.822%.
Good morning everyone. Today I am going to talk about the question CB. Firstly, I will read the question. Question 6B. NJU Holding Berhad plans to install a new machine P and machine Q. The cash flow of the two mutually exclusive machines are as follows. Year, machine P RM bracket RM machine Q bracket RM. The 0 year 600,000 and 900,000. The year 1 for machine P 350,000 and machine Q 450,000 Q. For the year 2 machine P 350,000 and machine Q 450,000. Year 3 for machine P 350,000 and machine Q 450,000. And year 4 machine Q 350,000, machine Q 450,000. Calculate the cross rate of the two machines. Step 1. Calculate the difference in cash flow. Year 0, machine fee 300 different, Q minus P. For year 1, 100,000 different. For year 2, 100,000 year. For year 3, 100 ringgit Malaysia different. And year 4, 100,000 ringgit different. Step 2. Calculate the IRR of the difference in cash flow. Year 0, 300,000. Year 1, 100,000. Year 2, 100,000. Year 3, 100,000. Year 4, 100,000. The formula 0 equal E for difference in cash flow divide bracket 1 plus IRR plus T. 0 equal 300,000 divide 1 plus IRR divide 0 plus 100,000 divide 1 plus IRR bracket plus 1 plus 100,000 divide 1 plus IRR divide plus 2 plus 100,000 divide 1 plus IRR bracket plus 3 plus 100,000 divide bracket 1 plus IRR divide 4 and bracket 4. IRR equal IRR divide minus 300,000 100,000 100,000 100,000 100. Using Excel, the answer is 12.98%.